We continue with the earnings report today with SoFi under the spotlight. They just reported before the market opened, and as we can see, they are up nearly 5%. When we look at the actual earnings themselves, looking very positive. Their net revenue of $599 million, as we will come to see, beat their own guidance that we have, and their net income as well of $17 million was a very strong beat. On top of that, they now mark the third consecutive quarter of having GAAP profitability. And when we take a look at the investor presentation that they did release just today, we have some good news for shareholders. The first one that we do want to discuss is the new member additions, which is a very important metric for this company. Now, quarter two, that is what they just released today, on a year-on-year basis, they are up 41%. Just look at that over the last few quarters. That is very strong growth on a quarter-by-quarter as well as year-on-year basis, and they have managed to add 643,000 new members just over the more recent quarter. So a good performance based on this one key performance indicator. Then we look at their quarterly performance in terms of the revenue, and this is a very important number here. 22% is the growth that they have seen on a year-on-year comparison. So quarter two, as we can see, 597 million, a lot stronger than the same quarter in 2023 at 489. So you could argue with the numbers we've seen so far, the growth story is continuing. We then look at the quarterly adjusted EBITDA, the earnings before the interest, tax, depreciation, amortization, and we can see it has increased 138 million from the same quarter last year at 77, in fact nearly double. And one thing that is quite strong to note, it still has a very healthy EBITDA margin sitting around 23%. Again, if you want to compare it to the same quarter from last year, 16%, much lower. So always a great sign to note that growth on a year-on-year basis. Then we take a look at something that I really like to see when we compare their actual results for the quarter. 597 million. That is much higher than the higher element they had of their guidance of 565. When we look at the adjusted EBITDA of 138 million, that is higher than the guidance that they had at the upper end of 125. And the same applies for the margin of 23% versus 22, as well as their GAAP net income 17 million versus the 10. So overall, we are seeing some very strong numbers with SoFi, which is very great to see, especially as we have seen that share price suppressed for quite some time. We then look towards the future in terms of their guidance, and you'll be very happy if you are a shareholder to know that they have increased the guidance. Always a great sign. They now see the net revenue of 2.4 to 2.5 billion, where the previous guidance said around 2.4. So that is a very strong indicator that management do believe they can continue to surpass their estimates, and that will put the annual growth at around 17 to 19%, as opposed to the 15 to 17 we saw previously. That also does extend to the adjusted EBITDA, as we can clearly see, 605 to 615 from 590 to 600. And this is pretty much the same for every other metric, the net income, the earnings per share. So great news from a shareholder. Not only did they beat the analyst targets, but they also beat their own guidance and lifted the 2024 full year expectations. Now, one thing that we quite like to do is to see how their underlying metrics are as a company. The first one that we want to have a quick look at is the free cash flow per share. Now, we have noted over the last 10 years, there have been very minimal years where they've been free cash flow positive, but we can see over the next 12 months, they are anticipating around 54 cents per share. Again, something we would like to see moving forwards. We can then take a look at their sales growth. Now, as we mentioned, it is very strong at double digits on a year-on-year basis from 2019, but for 2024, they are estimating just under 20%. So bear in mind with this company, while we have some great news, they are adding new members at a very nice rate, as we've seen in line with the previous quarters. Their top line revenue, whilst very attractive at the double-digit rate, has started to slow down since the highs of 2021. And we can see this translated in the numerical format, 510 million of sales in 2017 to just over 2 billion in 2023. One thing though we always have to point out is over the longer term, they have been diluting shares, so do bear that in mind as your position as a shareholder. Ultimately, we do prefer to see companies that return excess cash through their share buyback. And then the final metric that we do want to discuss today is that net debt to EBITDA, the earnings before the interest, tax, depreciation, amortization. Typically, we want to see below 3. Now, 5.27 in 2023. Nice to note, over the next 12 months, 0 expected, meaning it won't even take them 1 day to pay off all of their debt, net of cash on hand. A very strong balance sheet, as we're about to find out. We also want to let you know we have released our latest articles. For those that are paid subscribers, you will now have access to August undervalued stocks, where we have 35 for your consideration. As we can see here, the first one we do believe to be Visa, and we go through each one that is also in our portfolio. We also have many other articles that you can access completely free. As always, you can see these by clicking on the pinned comment below. A few other things we like to look at the company before getting into the valuation is the insider and institutional ownership. Insiders sit around 2.6%. We have 139 million worth of sales by the institutions over the last year. We have 139 million worth of sales by insiders over the last year, with around 1 million worth of buys during the same period. Now, in the more recent quarter, we have no buys or sells, but in quarter 2, we did see some buying at 600,000, although it was largely overshadowed by significant insider selling of 135 million. Now, when we take a look at who these insiders are, as always, for full transparency, we can see that the CTO, so the Chief Technical Officer, on the 20th of June, did sell around 56,000 shares at an average price of $641. As we can see, the share price is now higher. That was around $360,000. The CEO himself, Anthony Noto, did on the 14th of June, so a week earlier, buy around 30,000 or just over, and as we can see, $200,000. Now, this data could be argued to be a little bit out of date, given we are talking about now over a month ago, but as always, we do like to see insider buying. We do believe it is a bullish signal. Insiders buy because they believe the share price will go up. Whereas insider selling, we don't see it as a bearish signal. They sell for many reasons, whether it's personal or financial. We then look at these same data, but for the institutions with 38% ownership, we see 77 million worth of sales over the last year, with a lot more, in fact, nearly 10 times as many buys. So the institutions clearly do like SoFi Technologies. And in quarter 2, we see marginal more buys than sells. In fact, you'd have to go to quarter 2 of 2022 to see more selling than buying. But just remember, whether institutions or insiders buy, always do your own due diligence and never rely on what they do in terms of buys and sells. Now, a very quick look at their income statement, top line as well as bottom line. As we mentioned, revenue has been growing at a very rapid rate. 507 million in 2017, 2.1 billion in December 2023. Always great to see, but as we did mention earlier, the percentage-wise of this growth has started to slow down, but still the 17 to 19% for full year 2024 is still very healthy, but just something to consider and maybe apply it to the margin of safety that we did discuss. In terms of the bottom line net income, well, they are yet to achieve profitability. The positive to note here, though, as we saw for the third quarter in 2024 in a row, in fact, they have achieved GAAP profitability. Hopefully, we can see this for the full year of 24, as well as something that is consistent when moving forwards 25 and beyond. Then we like to have a quick look at the balance sheet for a quick health check. Total cash versus total debt. What we note, their cash position has increased largely more than 10 times, 325 million in 2018, 3.7 billion over the latest quarterly report. And as we can see, that is just the general trajectory of their balance. And as we can see, it has been increasing over the longer term. Now, as always, that number doesn't tell us anything, which is why we have a very quick look against the total debt numerically and directionally. Around 6.6 billion in 2018, and it has come down to around 3 billion in their latest quarterly report. Always a good sign when we see that cash has been increasing whilst total debt has been decreasing. No surprises then when we saw that net debt to EBITDA expected to be around 0. Very strong with regards to this element. We then want to point out the earnings, and as we can see, they did beat on their latest earnings per share, and we can see that trend over the last 2 quarters as well. They have beat, so nice to note the last 3 quarters SoFi has beaten the analyst targets. Now, over the next quarter, we do note it is negative due to the fact that comparing it to quarter 3, they did in fact have negative EPS. But over the next 2 quarters, they're anticipating some large growth to the earnings per share. And if at a minimum they hit those estimates for 2025, the forward P, which sits very high at the moment, will come down to around 31.5. Then we want to take a look at some gradings. Now the first one is the valuation element, where they do get a C. Again, it will depend on what metric you use, but as we can see, no matter which one you do use, against essentially the sector median, they are trading at a premium. But as always, you can argue that sometimes it is warranted for companies to be trading at a level that is higher than the sector, but do bear that in mind when you are considering the valuation element. We then look at their growth grade in comparison to the sector. Year on year, 35%, with the sector around 4.63. Revenue around 22%. Again, we can see mid-single digit for the sector. So that is a great sign that this company does justify the premium valuation. EBITDA growth 80%, significantly better than the sector's 10%. We then finally move on to the profitability. No surprises why it gets an F. As we mentioned, historically they haven't yet turned a profit, but we are hoping for the full year 24 we do see things turn around. Gross profit margin though looking very healthy at 82%. The sector as a whole sitting there at 60.48. Now a quick conclusion for this part of the analysis: a buy from Seeking Alpha, a double hold from the other two analysts, a C on valuation, A on growth with an F on profitability. We then finally move on to the comparison against others in the same sector in consumer finance. We have Credit Acceptance, OneMaid Holdings, as well as a few well-known others. And what we note over the last year, SoFi is the worst performing, down 35%. But what is very interesting to note, every single other company in this sector has returned a positive result. And when we expand this for over the last 3 years, we still see it as one of the worst performing, with every single one, again, over the long term, returning a positive result. So let's take this into the valuation and understand whether or not we believe this to be a great company to consider. Today our intrinsic value does sit at $11. As always, if you do enjoy the content, value is being provided as we go along. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, how we got to this $11, we did run it through the DCF model where we have the free cash flow year on year. The average growth rate will be skewed given it is negative, but what we do note for 2024, they do deem this to be positive, so we have put management's targets with a growth rate. Now we have used 6%, we have a low, medium and high, depending on which one you do believe to be justified. At the 6% level, with the discount rate, we get the present value of future free cash flows and terminal value. We add together with the cash, subtract total debt, get the equity value, divide by the shares outstanding, and we get $11. Now that does deem to be 45% upside from the current market value, but as always you could argue that is way too conservative. At 8%, this would then justify a $12.41 intrinsic value, giving 63% upside. And just for transparency, so you can see that 10% would indicate a value of $14, upside of 84%. Now you can always grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for SoFi or any other company. So let's be conservative, take the 6% through to the final slide where we get that intrinsic value of $11. Now we have a Wall Street price forecast of just over $9, where they do see upside of 19% over the next 12 months. But what we always like to do on this channel is apply a margin of safety, and at that 10% which we use and execute if the company meets the 3 golden criteria: wide moat, strong financial metrics, good forward-looking data, then we deem it to be acceptable. Well, if you believe that, well, buy up to $10, then we keep going till it's near the current trading price. And what we can see in today's episode, it does trade around a 30% MOS up to around $7.73. So 30% MOS on the estimates and judgments, with Wall Street around 19% upside. As always though, do let us know your thoughts below. Is this one you are buying after some very strong earnings result? Maybe it's on the watch list just to see how the rest of the day does pan out. And don't forget, if you want to see a lot more undervalued stocks, then do check out the newsletter, which you can grab by clicking on the pinned comment below, or joining us in the Patreon if you want to talk about any weekly buys and sells that we are doing. As always, let us know your thoughts. If you enjoyed the episode, smash that like button, and we'll see you all on the next one.